Hello, welcome to the Hub's ongoing election coverage. I'm your host, Sean Spear, editor-at-large at the Hub. Today, I'm grateful to be in conversation with Trevor Tombe, a professor of economics at the University of Calgary, director of fiscal and economic policy at the School of Public Policy, and one of the Hub's go-to experts on economic policy. We're speaking the morning of April 22nd. Just yesterday, Trevor published with us an article entitled "The Liberal Platform Walks Away from the Party's Own Fiscal Commitments." I'm grateful to speak with him about his analysis and what he thinks our listeners and viewers ought to know about the weekend's Liberal Party platform. Trevor, thanks so much for joining me.
Good morning. Thanks for having me on.
Trevor, let's just start at top level, if you will. Of course, the Canadian government is running ongoing deficits, in part because of the economic circumstances, in part because of the government's own policy preferences. It's your estimate that the Liberal platform, if effectuated, will make those deficits and debt period larger and longer. Why don't you just reflect on that?
Sure. So if we step back a little bit to earlier this year when the Parliamentary Budget Office released its baseline projections for the Government of Canada's finances, they were projecting consistent budget deficits between now and 2029 when their projections stopped. So we have about a $62 billion baseline deficit for the previous fiscal year, the one just ending a little over $50 billion. And that's going to gradually decline to about $25 billion by 2029. And so what the Liberal platform put out is a different set of numbers, obviously introducing some new initiatives, some tax changes, some other measures that will affect that. And they're showing, interestingly, not a single bottom line deficit in the projection. What they've done is they've split what they call the operating balance from the capital spending. And maybe we can circle back to whether that makes sense or not. But I estimate that what they would have had if they did report the kind of headline deficit is about a $48 billion deficit by 2028 when their projections stop. So that's moving from 27 billion in terms of the PBO's deficit projection based on current policy and current economic circumstances, or where we anticipate them to be, rising to 48 billion. So about a $21 billion increase in the projected deficit in those outer years. And indeed, we see a pretty material increase in the deficit in the platform every single year over the next 4 years. And what that means, and what I document in the piece, is that the very trajectory of public debt is now fundamentally different than what the government's own commitments were. Ideally, for sustainability, a government should look to whether it's growing debt faster than the economy.
Yes.
That, during a recession naturally occurs. The financial crisis, we saw about a 5 percentage point increase in the debt to GDP ratio, but it can't go on forever. So what you need is a trajectory that features debt growing more slowly. That was indeed the government's own prior commitments. They called it a responsible fiscal anchor to bring debt to GDP down over the medium term, to have deficits of less than 1% of GDP starting next year. And they highlight in their own budget last year that this is important to preserve our AAA credit rating, to maintain investor confidence, to keep borrowing costs low. And all of that is true. But what we see in this platform is that now, with these pretty dramatic increases in projected deficits, that the debt to GDP ratio, instead of pointed down, is pointed up and will be growing over the coming 4 years, which is kind of a fundamentally different position and basically abandons what the government's own fiscal anchor was.
We'll come to the subject of how to think about the distinction between operating expenditures and investment in a minute. Um, but notwithstanding the deteriorating economic and fiscal picture that you just presented, you argue in the piece that there's actually downside risks. One is the potential for further economic deterioration, a possible recession, which of course would have impacts on revenue and expenditures. The second is the platform embeds within it plans to achieve $13 billion in annual savings without a lot of details on what that entails and how it would be implemented. And I would add a third, Trevor, that is embedded in the plan with respect to operating expenses. It presents a goal of holding expenditure growth to less than 2% a year, which is actually negative in real terms, quite a difference from the past decade. Why don't you just talk a bit about these three risks and the potential for actually the deficit and debt picture that you just painted to actually be worse?
Sure. So the PBO baseline projections that the parties are kind of starting from doesn't include estimates around what the trade war with the United States might mean. And that's not to knock the PBO. It's really
Sure.
hard to know at the moment what the nature of this unfolding situation might be with the US and what the implications are for Canada's economy. But no matter what scenario you might have in mind, any kind of uncertainty and trade disruption with the US, that's a negative for the Canadian economy. Rising uncertainty alone is going to lead many businesses to perhaps prudently pause on some of their investment decisions. We've kind of featured that in the hub quite frequently. I'd say this measure of dramatic increases in uncertainty. The Liberal platform,
Yes.
interestingly, includes that very same
Saw that.
measure within the platform. And that's something that will slow growth. And roughly speaking, in normal times, if GDP grows 1 percentage point more slowly, that increases the federal deficit by about $5 billion. That year. Now, things are complicated because tariff revenues, our retaliation generates revenue, and depending on how broad that retaliation is, some non-trivial amount of revenue. So a lot of uncertainty there. For context, the downside scenario in the government's own fall economic statement, if layered on top of the projections in the Liberal platform released a few days ago, we'd see a deficit this year rise to about $74 billion.
Yeah.
And that's about 11 billion more than what's projected in the platform. And next year, the deficit would be about $13 billion higher than what's projected in the platform. So any kind of slowdown in economic activity would see a deterioration of these projections in the platform. And I should say the fall economic statement's downside scenario is kind of optimistic if we do end up going into a broad-based trade disruption with the US. And hopefully we don't, but it's certainly there as a real risk. And then second, as you noted, the platform features what they're referring to as savings from increased government productivity. And I'd say that's a worthy goal, thinking about ways of delivering public services more efficiently. Absolutely. But details around how they hope to achieve 6 billion in savings next year, growing to 9, then 13, is somewhat unclear. And where those numbers come from, again, I can only speculate what's going on under the hood because there's not a lot of details, but that's roughly the same magnitude of the increase in military spending. Okay, so that might
Yeah.
be one anchor to which they're kind of pegging what they hope to find in terms of savings on the efficiency side of things. Or it's also the numbers you'd need to actually shrink the deficit at all.
Yeah.
So without those efficiencies, the deficit is 62 billion in the platform this year, and it's 61 billion in 4 years' time. So basically no movement whatsoever. And so the
And may
entire
I just jump
improvement.
in for a
Oh,
second,
sure. Yeah.
Trevor? Is such a good point. But the only other thing to emphasize to put the magnitude of these productivity savings in some context is I think if you adjust to 2025 dollars, the peak of savings under 1995 program review, it's something like 15 to 17 billion dollars annually. So embedded in the Liberal plan is something approaching the ambition of program review without, as you say, a lot of details.
Yeah, it's interesting. I haven't done that comparison. This is equivalent to about a 5.5% reduction in what they consider to be the operating, like non-transfer to persons, transfers to provinces component of the budget, which strikes me as smaller than what occurred in 1990.
But on a much narrower base, though, too, right? Because of course, program review extended to beyond just direct program spending to, as you say, transfers to individuals and persons. Sorry, I didn't mean
Yeah.
to
No,
interrupt.
it's a good point. Yeah, yeah. And I don't mean to suggest that this is not feasible or a worthy goal or something that I think whoever forms government ought to really prioritize these these sorts of reviews and initiatives to kind of ensure that the programs that we are delivering federally are both appropriate for the federal government to do in the first place, achieving their goals with the least amount of resources, maybe considering whether provinces might be better placed to deliver them versus the federal government, and so on and so forth. But this is where it'll be interesting to see what the Conservatives have in their platform as well, actually identifying areas where there might be concrete, realistic sources of savings rather than this kind of a black box that we see with the Liberal plan.
Just with remaining moments, let's just talk about this distinction between consumption and investment, or operating spending and capital spending. You note that that it's a bit imprecise. Maybe a two-barrel question to wrap up. First, talk a bit about how we should think about the two different types of spending from a definitional point of view. And then secondly, talk a bit about the underlying assumption that an increase in capital spending, or quote unquote investment, can pay off, at least in part, in the form of in the form of an economic multiplier. Is that a reasonable set of assumptions for the Liberal platform?
Yeah, a couple great questions there. So it is important to think a little bit differently when we're talking about capital versus operating spending, for the simple reason that the benefits of capital spending, so long as it's not a bridge to nowhere, it generates benefits into the future. And so what debt can do is transfer some of those costs associated with the construction into the future. And think about true capital projects that really have generational benefits. The Confederation Bridge to Prince Edward Island, Site C Dam in British Columbia, most recently the Trans Mountain Pipeline, for example. These are very long-lived assets that will generate benefits for future generations. And one could argue that using debt to finance a lot of the construction costs so that it's not the current generation paying all of the costs associated with the project can make sense. Now, those are obvious examples. It's obviously capital, but what about filling potholes? What about maintenance capital? This is not new infrastructure with generational benefits. This is something that just kind of ensures the current stock is maintained, and that has benefits that are more focused on the current generation. And so having costs borne by the current generation to maintain capital that currently exists. Yeah. So where you draw that line is the tricky part. And then defining what is capital is sometimes tricky too. Is education spending capital? I mean, this is something that, yeah, if we have spending on education, high quality K to 12, that'll have benefits in the future with higher levels of human capital and so on. But that's not really capital in the same sense as a bridge or a power plant or a pipeline or what have you. And so defining what is and what is not capital is also tricky. And that's where there's some puzzling aspects of the Liberal platform. They have about 53 billion this year that they classify as capital, despite the fact that Statistics Canada's measure of federal capital spending in the most recent year is only 16.6 billion. So there's a great deal being classified as capital in the platform that wouldn't actually be counted as capital according to the Statistics Canada definition.
Yes.
I speculate that a lot of that is because it's federal spending to other entities that they hope will be using those proceeds to make capital investments. But that's kind of unclear in the platform itself. So I'd say that there's certainly scope for using debt to finance certain types of very long-lived capital, but the danger is in where you draw that line.
And just with our remaining moments, you want to talk a bit about whether this idea that public investment can and
Oh, yeah.
will, quote unquote, catalyze private private investment. Is that a reasonable basis for policymaking, or should the government be at least as concerned about the risk of crowding out private investment, given the borrowing ambitions reflected in the platform?
That's right. That's a great way to think about it. And I'm glad you mentioned crowding out, because that's exactly the right thing to have in mind. So if we think about major recessions, the financial crisis, the federal government in its budget then did roll out fiscal stimulus to try and move the needle on growth and lower unemployment rates. And at least during recessions, there's some evidence that increases in government spending on various projects can boost GDP growth. How much is the tricky question, but probably not zero in terms of what the effect is. And in its budget during the financial crisis, the federal government did explicitly lay out what it calls the multipliers. How much does GDP grow for each $1 boost in government spending? The argument there is somewhat contingent on there being a pool of available resources, either in terms of capital that's not being fully utilized or labor that is unemployed that can be shifted into activities associated with the government spending. So it does require some slack. When you have full employment or a labor market that doesn't have a great deal of that slack, then the multipliers are much smaller. And then another thing for Canada is there is some really good evidence suggesting that for small open economies, when you do have increases in government spending, that causes the exchange rate to move in a way that offsets the effect of the government spending. So you can have an increase in government spending, but that, if it strengthens the value of the dollar, will lead to a reduction in net exports. Add to that a potential for interest rates to be a little higher than they otherwise would be, leading investment to be a little lower than it would otherwise be. And it doesn't take much to have a full crowding out of the increased government spending, sure, but then decreases in investment and net exports, basically making the whole thing a wash where the multiplier is effectively zero. So, how to think about it in the current moment? I tend to think the multiplier is really small in Canada, potentially zero, and that should be the operating assumption. And I do tend to think that even during periods of weak economic activity. So I didn't really buy the financial crisis multipliers that the government has, but that's an area where reasonable people can agree or disagree. I tend to think that the biggest benefit of in terms of economic growth comes from when government initiatives are addressing a clear market failure.
Mm.
Is there an activity that ought to occur but isn't for some reason occurring because of maybe externalities in certain markets leading to an under provision of a particular good? Maybe there are some spillover benefits. And I think about, especially nation building infrastructure projects having potentially under provision in private sector leading to scope for government support. Research and development's a great idea. And as long as you're addressing a market failure, then you can much more convincingly boost growth. But that's not the framing that we see in the platform here. It's really just presented as government putting some money on the table, leading to more private sector investment. And sure, like if you're subsidizing something, you're going to get more of it. But the question is, are you simply going to be misallocating resources? Are you subsidizing an activity that really doesn't have a fundamental reason to exist in the Canadian economy? Or are you addressing a market failure? And at least past experience suggests that, think about superclusters or EV battery plants or other types of targeted initiatives by government when they're picking winners and losers can actually shrink GDP because it worsens the allocation of resources in the Canadian economy.
That's precisely the type of brilliant analysis I know our listeners and viewers and readers have come to expect. Trevor Tombe, professor of economics at the University of Calgary, thank you so much for joining us.
Thank you.